Perhaps the U.S. has dodged default, but that doesn't necessarily mean that financial market turbulence is also in the rearview mirror. How should you be thinking about your investments? A top investor's viewpoint, next on Quartz Smart Investing. Thank you for joining us. I'm Merrill Brown. Our guest today is Eric Beiley, Managing Director of the Beiley Group at Steward Partners. Eric, welcome.
Merrill, thanks for having me.
The markets appear to be cautiously embracing the agreement about default reached over the weekend. Are you comfortable with where we are and happy that, or at least content that debt ceiling problems aren't going to be roiling the markets further?
Yes, the markets do not like uncertainty. Uncertainty brings volatility, nervousness in investors, and so the announcement Sunday is certainly a positive development. And so now this week, we need to get to the next hurdle, which is the votes by both the House and Senate to approve it. But for now, I think the markets are going to react positively on the news.
What about the actual components of the deal? They're hard to get one's arms around about work related to food support and so on and so forth. Do you think these are positive for the markets in any way?
Yeah, I think just the overall having the deal concluded was what the markets wanted to see, because the markets really cared about the risks of default. And you saw some credit agencies come in and put warnings on our debt, and if a default happened, that would have been a real crisis. You could have seen default, you could have seen downgrades from the credit agencies, and that would have been a real negative impact on the markets.
Meanwhile, while there's all this uncertainty, the tech markets seem to be going gangbusters. And you yourself are supportive of the tech boom and have bought in. Why now, and is the AI bubble real?
It's incredible how strong these the NASDAQ and the growth stocks are performing. And so you have names like Meta and NVIDIA up well over 100% this year. And that is fueled by this AI, and you're seeing it in the earnings results. So the results are real. NVIDIA's earnings were impressive across. So AI bubble, clearly valuations are getting very high. And so we're at this level that makes me nervous from a valuation standpoint, but this trend is powerful, this AI trend, and I think it likely continues. You're going to probably see it more this week and into the future.
And ironically, at the same time, you're also recommending high dividend proven stocks like PepsiCo and Caterpillar. Why?
Yeah, strong balance sheets. You know, these are companies that have proven they're part of this aristocrats group, which are companies that have increased their dividend payments to investors every year for 25 straight years. And so through all types of economic cycles, these companies have proven that they can weather the ups and downs of business. And so their returns have been great. While this year their returns have been flat or some are down versus the market, over time they've performed extremely well. So I like these names here because their valuations, in my view, are reasonable.
Eric, your view is that the Fed's tightening may be over. What do you see ahead for us when the Fed meets in 2 weeks?
Great question. I think that's the biggest issue once we get past this debt ceiling is Fed policy and where interest rates are going. The markets certainly are pricing in now that we're near, either at the end or very near the end of these rate hikes. And so if the Fed continues to see inflation as this as a problem, that it hasn't dissipated and is still rising, you could see further rate hikes, which will certainly be negative for all asset prices. Equities included. So I'm hopeful we're near the end, but that's, in my view, that's the #1 issue that the markets face right now.
At the same time, the bond markets seem to be worried. Treasury yield curves are a warning sign. Why?
Yeah, because the yield market has been inverted since last summer, meaning short-term rates are higher than long-term rates. And so bond investors are indicating if you're going to buy a longer-term bond, you think rates are going to be lower in the future. And that means they see economic activity being lower and decreasing. Oftentimes it means a recession is on the horizon. Typically an inverted curve indicates a recession, and we haven't seen those signals yet. And so the bond market has been telling us for a long time to be cautious and to be nervous. And so the question is, who is right? Are the bond investors right, or are the equity markets, which seems to be much more positive and bullish, right? And as an advisor to clients, I take a more cautionary kind of in the middle stance. I'm not sure which one is right, and so I try to weather this uncertainty and get investors and my clients through it.
And part of your cautious side, the cautious side of your brain says Fed-backed CDs make a lot of sense. Why is that?
Absolutely, because especially now with this banking crisis that hopefully is behind us, where you had 3 large banks get taken over and put into receivership. And what's happened is banks have been paying very low rates on their deposits, but now depositors have woken up and are demanding high rates. And banks need deposits, right? They want to have sticky deposits. CDs are a great way to lock in those deposits. And so banks are offering above Treasury yields, very attractive, well north of 5%. And these are FDIC insured up to $250,000, so they're very safe. And not a bad place to park some money while we get through this uncertain environment.
What are the chances as we move now into mid-2023 of a recession?
Again, I think it seems likely just because of the impact of higher rates. Higher rates has a huge impact on especially access to funds, right? Access to credit. It makes everything more expensive, whether you want to borrow money, whether you want to finance a project, whether a company wants to expand or hire people, everything costs more. And so that has a trickle-down impact on the economy. It's going to make companies reevaluate how many people they want to hire. It's going to make people reevaluate spending. And so I do believe eventually it's going to slow the economy down. Recession is a tough one. I think economists, have been predicting recession here now for several months, and we're not seeing it clearly, right? The job markets continue to be tight. Housing is holding up well. So while I think a recession will happen, I can't, firmly agree right now with that.
Well, fair enough. Eric, thank you for joining us, and have a good week ahead.
Thanks, Merrill.
For more of today's top business news and insightful analysis, stick with QZ.com.